Hey class, this is Rob Bricker, and I am speaking to you from my office in Cleveland, Ohio, a long way from Madrid, Spain. Today I'm going to present our first distance learning based module, and it's going to focus on investments. And I've divided this presentation into 4 separate parts. So, the topic: investments. And in the first section, I'm going to provide you an overview, basically. In the overview, we're going to try to define what investments are, look at the basic accounting treatment, and the alternative methods of disclosure, what some of the basic issues are around valuation of investments and how they might be disclosed, as well as think about specific financial statements and how they might be affected. Then we're going to take a look at kind of the contemporary issues that we're facing. So in particular, all of you are familiar with the various debt crises that both Western Europe and the United States have faced, beginning of course with the mortgage securities crisis beginning in 2007-2008 in the United States. And of course today now we're dealing with a number of sovereign debt crisis issues. And the Greek sovereign debt crisis issue is of course of particular concern, and many of you have been hearing about different banks that are susceptible to some problems, for example Dexia. So we'll talk about some of those issues in the second part, and in the third section we're going to look at some of the accounting rules. So we'll look at in depth at how different accounting treatments can be used, whether our investment is going to be recorded at its cost, or whether we can write it down sometimes, or whether we're going to mark it to market, or some other treatment. There's some specialized treatments for large investments that we can use as well. And the final section we're going to look at is the in-depth accounting rules for each of the major categories of types of investments that we come up with. So we'll start with this overview, then we're going to turn and look at some of the current issues that we face. And then the third section is going to focus in on the specific accounting rules that we're dealing with now. And the accounting rules, as I said, basically are in terms of categorizing the types of investments that we're dealing with, and then looking at how they're recorded from a transaction point of view and how they're disclosed in financial statements. And then finally, in the fourth section, we're going to look in depth at each of these categories of investment types. So we'll say, for example, what if it's a marketable security that has a quoted value on a stock exchange? How do we deal with that? What if it's a long-term investment, a long-term strategic investment in a company that we control? How do we deal with that? So we'll look at each of those in detail. So each one of these is going to be a separate module that you'll be able to view, and we are here right now. So this first section that we're looking at is our overview. Now to start with, let's take a look and think back to where we were when we met in Madrid, which is that we were dealing with the accounting equation. So the accounting equation just says what? Assets. See, you have new markers. Isn't this great? They all actually work. Assets equals liabilities plus equity. And remember that the equity can include things like invested equity, which is what a shareholder might contribute in exchange for common stock to begin with, as well as the results of the operations of the company. For example, in the form of revenues and expenses. So each of these, of course, are just broad categories. And there's lots of different accounts under each one of these, but we only have so much boardroom, and so that's the way we're going to show it. So we're going to start with this, and we think about what is an investment? Well, an investment is basically when we buy something to gain some sort of a return from its holding. So in other words, we buy it because we think that whatever it is that we're going to buy is going to generate some kind of return in and of itself. You could think of that even as something as simple as investing in a CD or a treasury bill. Some of these might be just considered like cash, so maybe that's a bit of a stretch. But the basic idea is that we're going to earn a return from the employment of the asset in some use outside of the normal productive enterprise that we undertake. In other words, outside of our core business activity. So we've got spare money, or we're making some kind of a strategic investment or something. But you can see then that what we're doing is assume that we acquire some investment of any kind for cash. And we're going to just have our two accounts here under assets of cash and another one called investments. And so what happens when we buy something for cash? Well, we give up one asset and we get another asset. What did we give up? We gave up cash. So cash is going to decrease and the investment is going to increase by whatever amount that we pay. So if we spend a million euros, that would be the wrong symbol, wouldn't it? We'll use that. If we spend €1 million on an investment, cash goes down, investments go up. Now, this shows that normally when we acquire an asset, it's originally recorded at cost. And that's pretty common. So cost at the point of acquisition is regarded as an exceptionally reliable and relevant indicator of value. It's an arm's length transaction. We assume that that's the case here. And so initially at the point of acquisition, we can record it at whatever we paid for it. Now, subsequent to the acquisition, we have other questions like what do we do with it next? So for example, what if the value of the investment goes up or goes down? I'm not talking about actually selling it. I'm just talking about it being worth more or less. I'm sure some of you own stock, or maybe you just own other things that whose value you think increases or decreases. And so the question would be, if you sort of thought about your own personal balance sheet, what would be going on with those things over time? And so the same thing happens here, but with financial accounting and financial reporting, there are specific rules that we've got to comply with, because remember, accounting is the language of business. We have to make sure that everybody knows what the rules are with respect to how things are recorded in the disclosure, so that the story that I tell as the manager when I'm reporting this stuff is understood to mean the same thing by those that are reading it, by those that are looking at the financial statements. So it's literally a language in the sense that we've got to have the same syntax, the same grammar, the same words mean the same things. The financial statements, as they're prepared in a particular way that says the investments are this, have to mean the same thing from my point of view as the preparer as they do from yours or from other investors' point of view as they're reading and looking at them and trying to interpret what they mean. So at the point of acquisition, whatever the investments are, we really haven't defined the kinds of investments they are other than some general sense. It's an asset. And at the point of acquisition, it's recorded at cost. After acquisition, what could we do with it? If the value might go up or the value might go down. Or it might not do anything. But to make it interesting, let's just think about the two possibilities here. So we could have an increase, or we could have a decrease in value subsequent to the original acquisition. So, what should be the accounting for that? What would be the options? Think about it for a second. I mean, you might say, well, do nothing. Doesn't matter if it goes up or down. You show it at its original cost. That's the historical cost basis. Or you might say, well, you know, I remember that accounting is supposed to be conservative. So, we're not going to let you write it up, but it's okay to write it down. So in other words, if the value has increased, we won't do anything. But if the value decreases, write it down. And so you might have like something like a lower of cost or market is one approach to that, or we have another kind of an asset measurement called an impairment test. And if we look at an impairment test, basically we're saying, gee, has the value of this gone down? Well, then it ought to be written down. So that's possible. Or we could have something like mark, that's supposed to be an A. Anyways, mark to market. And mark to market means, well, if it goes up, we write it up, and if it goes down, we write it down. That's what we record it, whatever it's valued at. I mean, there are lots of issues that go right now. This is just a general kind of perspective. There's lots of things that go into this that you have to think about in making a determination about what to do here. So, for example, if you have some kind of an illiquid asset, that would be something that you really don't have very good estimates of values other than maybe an appraisal or just what you think it might be worth. Do you have enough confidence in that? Do you think it's justifiable to actually record some change in value? So those are some of the things, that's an example of one of the things that we think about and try to decide what to do if we think the values have changed. And you're probably kind of guessing ahead here that if we have a good reliable basis for the valuation of an investment, then we can change those values. But if we don't, it's much more worried about that. And that, you know, as we look at some of the things we're looking at today, like the sovereign debt crisis and the mortgage-backed securities crisis thing in the United States, that's a big deal. Because a lot of times you deal with illiquid securities, we're trying to figure out, are they worth less? Are they permanently worth less? Are they temporarily worth less? Do we know how much less they're worth? Hard. Very, very difficult issues. And for those of you that have had a chance to look at the discussion board, you'll see that it turns out that because there's lots of legal contracts and contractual issues, and for example, even regulatory issues wrapped up with how these things get recorded and valued. For example, capital sufficiency measures of banks, they're not just simple accounting things that you try to decide about the accounting. Whatever you decide is going to have huge implications for what happens with banks and perhaps the economy and maybe even the entire political system. We don't know. It gets very messy. We kind of think of accounting as boring and dull, but in fact, here was an example if we look at sovereign debt issues and, for example, how banks are going to record the investments that they hold in the sovereign debt of countries that we're not sure are going to be repaid. How do you record those? And what's going to happen if you make the companies like Dexia write those down? They just did that, right? They just wrote down like, what, $12 billion? This is a big deal. What's everybody worried about? Contagion, panic. It's, you know, it could be a big mess. So, as much as you would like this to be just about accounting, just about coming up with the best possible valuation, it turns out that's not always the only question that you're dealing with. So anyways, here's the big deal. We're not even talking about at the point where you sell the investment. When you sell the investment, you liquidate it, I mean, that really turns out not to be so difficult. The big deal is what you do between the time you buy and the time you sell. That's where we get into all kinds of problems. So, as we look at our overview here and we think about this, one of the questions is, how do we record it? The first thing is, how do we record it? Well, we record it at cost. What do we do in between, right, after we buy it? Well, that's a big issue. We're going to look at that in a lot of detail. There are many different rules for dealing with that. And then, finally, what about when we sell it? Well, when we sell it, that turns out to be a lot simpler. So, it'll turn out that we have different ways of recording this stuff that we deal with in between. Or do we have gains or losses, and are they realized or unrealized gains or losses when you're dealing with the changes in valuation while we're still holding these assets? But whatever we've done at the point of acquisition and whatever we've done with the valuation in between time is going to then determine how we record it when we sell it. So basically, when you sell an investment, it's pretty much like selling any asset. You're normally assuming that you sell it for cash. You're going to have an increase in cash, right? You're going to write down the investment for whatever it's recorded at on the book. So if it's still recorded at cost, that's what you'll write off. But if you have written it up or down, then the The final amount, the book value, the current value that you have is what